Hello everybody and welcome back to the channel. My name is Smart Money Mo, and in today's video we're going to be doing a full guide on how to enter aggressively from supply and demand zones, right? And we're going to be doing this breakdown with a lovely trade setup that I sent out on gold to the mentorship, right? As you guys can see here, sent out the chart, sent out the zone that I was looking at, all the analysis, all the good stuff. And then you can see here later on price reacted and it was a lovely winning trade of 3.5 RRs. Right, and setups like this are very often sent to the mentorship and have a high probability of initiating a winning trade for the students. So if you guys want to see those kind of setups, understand why I'm taking those setups, have the knowledge and ability to analyze those setups on the chart, make sure to check out the first link in the description. Check out the mentorship for a one-time fee of £120. Get access to all of this good stuff, right? And make sure to get in now. At this point in time, because when the new year starts, January 1st, I have a lot of big things that I want to do to the mentorship. I have some revamps in the strategy and whatnot, so the price will no longer probably be at £120. So make sure to get in right now while the price is still £120 for a one-time fee, lifetime access, before it may increase on January 1st. But yeah, guys, without further ado, let's get right into today's video. Alright everyone, so to kick things off, we're going to be talking about what it is you need to do on the higher time frame in order to enable a trade on the middle time frame, where you can just enter aggressively and enter straight away in order to enable those sort of quick profits and quick trades on the middle time frame without a confirmation. Because sometimes you might be confused as to whether you should look for a confirmation, whether you should go aggressive, whether you should leave the trade, whether you should switch your bias. So in order to clear up all of those things, we're going to start off with the higher time frame and find a bias to support our trade. So the four key things that I can possibly find on the higher time frame to help support a trade is higher time frame BOS, higher time frame liquidity sweep, higher time frame zone, or higher time frame order flow and trend. Let's go through each and every one of these. And by the way, you only need one of these to have a high time frame bias. So the first one is, of course, just a standard higher time frame break-off structure. A higher time frame break-off structure, for example, towards the downside, will indicate to us that price is moving towards the downside and is going to be bearish. So that means if we were going to take an aggressive entry on the middle time frame, it would have to be a short. Very, very simple bias, right? And if I was to draw a diagram, it would simply just be like this: price break structure towards the downside. Maybe on the middle time frame we have the zone. This is one bias telling us to short. The second one could be a higher time frame liquidity sweep. Now this is a bit more complicated, as let's say we're on the 4-hour time frame, right? And then price gives us a set of equal highs. So this is now liquidity on the 4-hour time frame. Then price comes here and it sweeps this liquidity. Now we can say that we have a bias towards the downside. Why? Because we know that when price sweeps liquidity of this sort on the higher time frame, we can expect a reversal in the opposite direction that the liquidity sweep was in. So we swept liquidity towards the upside here, so then we can expect a reversal towards the downside. Okay, so this would be another confirmation for shorts. Now let's go ahead with the list. So next would be a higher time frame zone, right? And this is just simply where price has given us a zone on the higher time frame which is valid. So for example, here it would be a demand zone, and this is an indication to buy on the middle time frame, right, or the lower time frame. So in this scenario we would have a bullish higher time frame bias. And then lastly, we can go over order flow or trend bias, right? So on the higher time frame, if there is just a strong sense of price respecting a trend in one direction, then we can just say on the middle time frame our trades should be bullish, right? Since price is respecting demand zones and constantly running through the next high. So what we clearly have here is a case of bullish order flow. Now, all of these biases are helping us take, in this scenario, in this video, take an aggressive trade on the middle time frame, right? So once we have established this higher time frame bias, then we move on to step 2, which is to switch over to a middle time frame, right, or mid time frame, which is something like the 10-minute, 15-minute, sometimes 30-minute, right? But I'd say these three time frames is where you'd want to be looking for on the mid time frame. And what we're looking for on these time frames is a supply or demand zone which follows every single one of the SM2 supply and demand zone rules, right? Now, of course, the supply and demand zone has to be adherent to the higher time frame bias that we previously made, right? So if our higher time frame bias that we previously made was bearish, then we'd be looking for the supply zone, right? And this supply zone has to follow every single one of my rules. And if it does, we'd call this zone a SM2 zone. SM2 zones simply mean a high probability zone, right? And I'm not going to say high probability every time, so instead we'll just call them SM2 zones. So in order to have an SM2 supply zone, we need to see all 6 of these rules, okay? Now, these 3 rules you should already be familiar with, which is a break of structure, high volume, and no mitigation, right? I have mentioned these rules countless amount of times on my channel already. However, what will differentiate a normal zone between an SM2 zone is these last 3 rules over here, which is a liquidity sweep, inducement, and price being in a premium or discounted level. Now, I have an example of an SM2 zone right here. And what we're going to do is we're going to run through each and every single one of these rules with the high probability zone that we have over here. And I'm going to show you guys exactly what to look for when trying to scout for one of these SM2 zones which go along with your bias. So in this scenario, let's just say our higher time frame bias was that we had some sort of zone that price had tapped into, or for example, we had a break of structure on the 4 hour. Now I'm looking to short. So first things first is I'm going to try and find the zone, right? And once I found the zone, the first thing I will look for is a break of structure. Why? Because a break of structure is the first indication that this zone has created some sort of significant move towards the downside, which is the favor that we are looking for. So that's the first thing I will look for. Secondly is high volume. Now, high volume is sometimes something that will go unnoticed today, but all I mean is, right, after price has created the zone, so after the up move that we have, which creates this zone, we're looking for a down move straight afterwards that is a quick, sharp move with high volume candles, right, and a bit of imbalance, okay? Simple as that. Now, the zone must not be mitigated. All that means is price shouldn't have already tapped into the zone. So if price had already tapped into the zone and then I was looking to enter from it again, it would not be valid, right? And there should be no wicks coming back into the zone as well, like this, okay? So in this example, price is yet to tap back into the zone, so it's completely unmitigated, and therefore we have checked off the first 3 rules. Now, the last 3 rules is the rules which will make this zone a high probability SM2 zone. First things first is a liquidity sweep. Now, what I mean by that is the move which created the zone towards the upside, right, should have also swept liquidity, okay? So you guys can see here that we have equal highs. Let's just say this is the 15-minute time frame, right? You guys can see here on the 15-minute time frame, we have these set of equal highs, right? And then price sweeps these equal highs. Now the move which swept those equal highs is later on our supply zone. So that is exactly what we need to see our supply zone doing for it to also coincide with this rule. So that's the liquidity sweep rule checked off as well, okay? Now inducement. All I'm looking for inducement is, in this case, we have a supply zone. So I'm looking for a supply zone directly beneath this zone, right? So somewhere beneath the zone, we need to find another supply zone, right? Which is going to act as inducement for our trade up here. Now, what do I mean by that? What I mean by that is we need a level which is going to incentivize early sellers to enter this market so that they can act as a level of inducement for my overall trade. Great. So that's the 5th rule done. Now, the final rule is just about the positioning of the zone. Now, we want our zone in this example to be as premium in this range as possible. And as you guys can see here, we are far into the premium level of this zone. And anything below the 50%, so anything over here, if we had any supply zones over here, they would not be valid. right? So now that we've gone through all 6 of the rules and we can see that this zone follows them perfectly, what we can do is we can simply just set our limits from now, right? And this is what I mean by entering aggressively, because we've got this 15-minute zone. We're not going to be looking for any more confirmations. We're going to be entering from the zone straight away, right? Entry here, stop loss here, and TPs, somewhere within this range, right? We're not going to wait for price to make a market structure shift in our zone and then we're going to enter on the lower time frame. No, we will be entering directly from this zone aggressively, right? And we can now do this because we have the high probability SM2 zone and we also have the higher time frame biases coming into play to aid us with the higher probability sense of this zone. So guys, we've gone through everything that we need to go through in terms of the knowledge and the diagrams. Now let's shift onto the real life charts and break this down and break this guide down with that beautiful setup that I sent to the mentorship on gold. So I'll see you guys there. Alright everyone, so now that we're on gold, we're going to start off this breakdown on the 15-minute. I've got the rules over here on the top right hand side just for later on for the reference, right? And we're going to be starting off this breakdown with this zone that we've got on the 15-minute, right? So I identified this 15-minute supply zone as, a potential supply zone, that we could potentially take a trade from. Nothing yet so far. But once I had found the zone, I instantly switched over to something like the 1 hour or the 2 hour where I can start crafting my overall bias. So first things first was price. This is just a sub point, right? But price was just made an all-time high on gold. So with that logic, right, if I see a break of structure on the higher time frame, I can assume that gold can continue to be bearish because every single time price on gold reaches an all-time high or goes near it to its all-time high, it then crashes down. Okay, so price made an all-time high and then it started to drop and then it instantly breaks through this low and gives us a failed demand zone, right? So price failed this demand zone, whereas it had previously been respecting these demand zones. Price had failed this one, and we got also over here a breaker structure, right? So that's the first thing that I noticed on this time frame. The second thing was we can also notice that we are actually having a sort of flip area over here, right, where the demand zone is invalidated, then price taps back in and it shows a reaction from it, right? These sorts of flip levels are, I'd say very, very powerful on gold, and price seems to respect them quite a lot. So this was the second bias that I had emerged on the higher time frame. And yeah, that was basically all I need, because I had saw the break of structure, I had saw the price coming into this flip level, then reacting from it. You can also take into account this sort of swing low being broken here as well. If I just zoom in, that low down there being broken as well. So we've got overall 3 sorts of biases that we have emerged from the higher time frame. Now I can confidently go on to the 15-minute and look for sells because I am sure of it due to my higher time frame bias. Now I'll delete that, I'll keep that, and I'll keep this. So we've got this 15-minute zone. Let's go through each and every single one of these rules, which will make it a valid zone. Now, let's start off with the break of structure. Now, the break of structure is, we have this swing low being broken, but in terms of the internal structure, we have this low being broken. Okay, so first things first is we've got our break of structure. Very, very standard, simple procedure. High volume is apparent. Right, price made its zone. We have this last high up here. We could take into account this whole zone or just this high. It really doesn't matter. But yeah, after price left this high, we can see the next candle engulfs it, and then the following candles are quite high volume, right? And we can see some imbalance emerging over here. Okay, very, very simple. High volume, no mitigation. Price is yet to tap back into the zone at all, right? It's very, very simple. We don't have any movements back into the zone. We are completely unmitigated. Now, here comes the other 3 rules. First things first is we have a clear liquidity sweep of equal highs coming about, I think, on maybe the 5-minute time frame. So yeah, price created these equal highs, and then we were left with a nice little liquidity sweep over here, right? And guys, a trick for liquidity sweeps is you can tell your liquidity sweep is valid when wherever price swept the liquidity, if there is an increase in volume, right? So hence this candle, then you can tell that it's a valid liquidity sweep, right? And you can see here, price also swept through these highs, right? So we even got a double liquidity sweep coming into play through this candle over here. Now, we also have our level of inducement here on the 15-minute, right? We have this supply zone that price is approaching. If I can just replay it to about there, that price is approaching, and this could be a potential setup for traders to trade from and sell from this level, right? So we'll unmark this with the box and we'll remark it with our inducement. Okay, so this is our level of inducement, which is going to be the level that again makes this zone one of our SM2 zones. And then lastly, positioning. So price is well positioned if we take this swing high and we bring it all the way down to the swing low within our range. We can see we fall beautifully within the 89 level and the 79 level, right? And we're well above the 0.5 level. However, this close is quite nearer to the 0.5 level of this range, hence it being a less or a lower probability zone. So we follow all 6 of these rules, making this a high probability SM2 level zone, right? Therefore, we could be potentially entering off of this zone in a aggressive manner. Now, I also found an extra bias in that we had a strong sense of bearish order flow, right? And I can make a whole separate video on this, hopefully coming up in a couple of days, about how order flow can benefit your trades very, very well, right? Price, this tapped into the flip zone back here, and then that tap made a zone, and then this tap made a zone which tapped into there, right? So there's a strong sense of bearish order flow being created here. So yeah, now that we've gone over that, we've gone over even a 7th bias for this trade. Now let's switch back onto the 15-minute and get our entry sorted. So we've established that this is a 15-minute level, right? It's an SM2 zone, so meaning it's a high probability zone. We've got all of our rules. All we need to do now to enter aggressively is literally set our limits. And yeah, we're good to go, right? Now, in terms of tick profits, I noticed something interesting on the time frame that we were playing around with, right? We were trading on the 30-minute/15-minute, and I saw that price had tapped into this zone, right? So what I want to do is stay safe. By the slight off chance that price might come back and retest some of the highs over here, right? Retest some of the zones over here, right? And it disregards my analysis, because at the end of the day, Forex is trading as a game of probabilities, so anything could happen, right? Let's take into account a slightly bullish narrative, right? And we have this bullish zone, price tapped into it, showed a nice reaction. So where's the next valid supply demand zone? Well, we have one over here that we can target for a nice 3.5 Rs. Okay, so that is an easy 3.5 risk reward ratio on the 15-minute. So let's go back there and let's see how price reacts from this high probability zone. So instantly price comes in and starts dropping, right? And in the space of literally 1 hour and 30 minutes, we hit a full 3.5 RR trade, right? Now, this is essentially all you need to start taking trades aggressively from these sorts of mid time frames, from the 15-minute to 30-minute and that sort of thing, to enable yourself to get nice 3.5 risk to reward trades in the space of 1 to 2 hours, or just in a trading day alone. So guys, hopefully you guys found that very beneficial and educational. If you guys like these videos, make sure to check out my other ones, and yeah, subscribe, and I will see you guys in the next one.